What's up guys, my name's Curtis and welcome to 5 Minute Finance, where I take personal finance topics and explain them to you in 5 minutes or less. Whether you're new to investing or have been investing for years, one of the big decisions you'll have to make is whether you want to park your money in actively managed mutual funds or index funds. I believe there are three main differences between actively managed funds and index funds. Those are performance, fees, as well as turnover. So let's go into each of those a little bit more. When it comes to performance, the goal of index funds is to exactly match the return of whatever index they're built around. For example, an S&P 500 or a Dow Jones Industrial Index fund is going to be comprised of the exact securities that those indices themselves are comprised of, thus matching the performance of such indices. The goal of actively managed mutual funds is to not just match the index performance, but to outperform the broad market. The problem is, over the long run, most mutual funds don't outperform their index fund counterparts. According to Investor Junkie, almost 90% of actively managed mutual funds underperform their index fund benchmark over the course of 15 years. Plus, even if you were lucky enough to choose one of those 10 to 12% of active fund managers who did beat the market over the previous 15 years, most likely that same manager isn't going to be able to beat broad market index funds for the next 15 years. So when it comes strictly to performance, I personally would always take the safe bet and go with index funds. Difference number two has to do with the expense ratios built into these funds. Since index funds are passive and don't require so-called financial experts to manage them, the expense ratios are extremely low. Per the website NerdWallet, index funds have an average expense ratio of about 0.09%. Mutual funds, on the other hand, cost a lot more and have an average expense ratio of 0.82% because, again, those fund managers need to get rich somehow. What that means is, on an investment of, for example, $100,000, an index fund would cost you $90 per year on average in expenses, whereas a mutual fund would cost you $820 per year in expenses. This extra expense would be worth it if the actively managed funds outperformed their index fund benchmarks, but as we just discussed, most of the time they don't. So, just to cover the difference in expense ratio, the mutual fund would need to outperform any index fund by 0.75% every single year. And we already said that 90% of mutual funds don't outperform indices over the long run. If you take into account expense ratios, I bet that 90% is actually closer to maybe around 95%. So, at least in my opinion, index funds seem better both when it comes to performance as well as fees associated with those funds. But there's one thing that I think a lot of people don't talk about enough, and that's turnover within the funds. See, active fund managers are constantly buying and selling stocks, bonds, securities, so that they can hold what they think is going to appreciate the most. This means they might rebalance the fund monthly, daily, or maybe even hourly. According to Morningstar research, the average actively managed mutual fund has a turnover rate of almost 63%. That means every year, 63% of that portfolio is being sold and replaced with other stocks and bonds. If you hold one of these mutual funds in a tax-advantaged account like a 401k or an IRA, this really won't affect you very much. However, if you hold these mutual funds in some sort of taxable account, when it comes time to file your taxes, you might owe more than you really thought you were going to. Most index funds have a turnover rate of less than 5%. If you're having trouble understanding this concept of turnover rate, just know that in general, for tax purposes, a lower turnover rate is going to be much better than a high turnover rate. So I just went through the three main differences that I think of when comparing mutual funds to index funds. And at least in my opinion, index funds are the much better option. They're cheaper, easier, and they almost always perform better. From everything that I've read and listened to, and I read a lot of personal finance books, it seems like the only people who are recommending actively managed mutual funds are the institutions and the managers of those funds, and that's because they make a lot of money by managing those funds. Just about everyone else out there in the personal finance realm recommends just buying broad market index funds. At the end of the day, I myself can't make this decision for you, and again, I'm not a financial advisor, but in my opinion, index funds are the far superior option. If you guys enjoyed this video, it would really help me out if you gave it a thumbs up, and if you're new around here and would like to see more personal finance videos in the future, click on this globe right here to subscribe and hit that notification bell.